Well, certainly on the technical side, as well as with some of the indicators like rates rising, it's not quite as good as it was at somewhat earlier this year. And yet at the same time, you've hit new highs and the economy is strong enough that it would be extremely rare to see more than a market correction over the next few weeks as you look out a little bit longer. Obviously, if the economy deteriorates, you've got the prospects of a broader sell-off. But for that reason, I think it's normal to see some deterioration, particularly off a high of this sort, and it's nothing to get too concerned about.
You know, Dan, when you take a look at rising yields, you take a look at the rising dollar, you take a look at rising oil prices, you say that this all points to strong economic growth, and yet right now they are headwinds to the stock market. At what point do we sort of break free of that notion that they are headwinds and say, you know what, this is a sign of economic growth and therefore further gains, or do you not?
I don't really look at it that way, Melissa, and here's why. When I look at the yield on the 10-year, that's been kind of predicting higher rates for a while. You know, we've been in a trading range for the last 5 months, but the economy's been really strong. We don't need to go through the numbers, but we're starting to see when I look at the 10-year and what's happened today, I think about, you know, the little Dutch kid with his finger in the dike. Today was a pretty big leak, and but the market's kind of been leaking for quite a while. But I think Bruce kind of brought up a good point, a good distinction between in time frame. What are you looking for in the short term versus the long term? And I wouldn't be really negative on equities right this minute. I mean, as a trader, I'm kind of looking for a little rebound, but we've been seeing some real deterioration in mid caps and small caps. Those have been falling. They broke key moving averages in the 50-day moving average. We saw retail sell off in a big way the other day on really high volume, and that's been a real leader. You know, I heard the guys on the last segment talking about some of the retail stocks, and they've been really strong for quite a while. But I don't think there's a lot of money to be made in them right now because of the overhead resistance. You know, the retail traders tend to get in right at the top. And so I really feel like at this point, you want to peel back, look at the home builders. You know, and I heard Josh talking about how he thinks that the market's ready for these higher rates. I don't really agree with that. I agree that the home builders are ready for higher rates, but we're seeing these big flashing red lights now because of the 10-year, but this stuff's been going on for a while. So I think look at the FFTY. That's the IBD 50 ETF, the ultimate growth. That's starting to break down too. So I don't want to filibuster here, but the bottom line is I think that you really want to be careful and think like either a trader or a long-term investor.